The United States has dramatically escalated its trade war with China by enforcing a 145% tariff on imported Chinese goods. This decision follows an earlier announcement by former President Donald Trump, who initially proposed a 125% tariff. The final figure, however, includes an additional 20% levy that was already in place. This abrupt increase in trade restrictions has not only heightened tensions between the two economic superpowers, but has also triggered uncertainty within the U.S. administration and Congress. The policy shift has sparked debates over Washington's trade strategy, with critics pointing out a lack of clarity and internal discord regarding its long-term effectiveness. More than just a bureaucratic maneuver, the tariff hike represents a direct economic blow to China, targeting its manufacturing sector and disrupting supply chains that have long supported global trade. One of the hardest-hit segments in China is its small and medium-sized enterprises, SMEs, which play a crucial role in the country's economy. These businesses contribute approximately 60% of China's total exports and account for around 80% of private sector jobs. According to recent estimates, the first quarter of 2025 has already seen a drastic decline in Chinese exports, with order volumes falling by 30%. Rising operational costs, combined with these unprecedented tariff barriers, have left many Chinese businesses struggling to stay afloat. Adding to the pressure, many foreign companies that once relied on China as a key manufacturing hub are now reconsidering their operations. With higher tariffs making Chinese goods less competitive, multinational firms are looking for alternative locations to set up production. This shift could weaken China's economic standing in global trade and further destabilize its industrial workforce. However, this tariff escalation is not just an economic battle, it is also a geopolitical maneuver. Trump's aggressive tariff policies aim to reduce U.S. reliance on Chinese imports and push for a reconfiguration of global trade dynamics. But the question remains, will these tariffs achieve their intended goal, or will they ultimately hurt American businesses and consumers as well? As the trade war intensifies, both nations face critical decisions. While the U.S. seeks to exert economic pressure on Beijing, China must find ways to navigate these restrictions, either by strengthening its domestic economy or by forging stronger alliances with other trading partners. The ripple effects of this economic conflict will not only reshape U.S. China relations, but could also redefine the future of international commerce. The global response to the United States' aggressive tariff hike on Chinese imports has been swift and complex, revealing shifting alliances and deepening economic tensions. Initially, the European Union, EU, strongly opposed Washington's unilateral decision, viewing it as a destabilizing force in global trade. However, as economic pressures mounted, the EU reconsidered its stance and signaled its willingness to negotiate with the U.S., demonstrating a strategic shift in its trade policy. This change in the EU's position highlights the delicate balance that many nations must maintain in an increasingly uncertain economic landscape. European leaders recognize the risks associated with full-scale trade conflicts and are keen to avoid being caught in the crossfire between the world's two largest economies. While some European industries benefit from reduced competition as Chinese exports face higher costs, others, particularly manufacturers that rely on Chinese components, are feeling the strain of disrupted supply chains. Meanwhile, China responded to the U.S. tariff escalation with a countermeasure of its own. Beijing imposed a 34% tariff on American imports, directly targeting sectors that are heavily reliant on trade with China, such as agriculture, automotive manufacturing, and high-tech industries. These retaliatory tariffs are designed to put economic pressure on the U.S., particularly in regions where Trump's political support is strong, potentially influencing upcoming elections. Beyond tariffs, China has also taken more strategic steps to assert its economic leverage. One of the most significant moves was the restriction of rare earth exports to the U.S., given that China dominates the global supply of these critical minerals, essential for producing semiconductors, batteries, and advanced technology. This decision has raised alarms across industries. Without a stable supply of rare earth elements, American manufacturers face production delays and increased costs, which could ripple through various sectors, from consumer electronics to military equipment. In North America, Canada has also signaled its discontent with Washington's trade policies. While Ottawa has yet to impose direct countermeasures, Canadian officials have hinted at the possibility of redirecting oil and energy exports away from the U.S. toward alternative markets. This would be a significant shift, as Canada is one of the largest energy suppliers to the U.S., and any reduction in supply could lead to higher fuel prices for American consumers. Taken together, these developments illustrate the fragility of the global trade system and the unintended consequences of protectionist policies. The U.S. tariffs were intended to weaken China's economy and protect American industries, but they have also triggered a chain reaction that threatens to disrupt international supply chains and diplomatic relationships. As trade tensions continue to escalate, businesses and governments worldwide are reassessing their economic strategies. Some companies are exploring ways to diversify their supply chains by shifting production to Southeast Asia, Latin America, or even back to domestic markets. Meanwhile, countries that once maintained neutral positions in the U.S. China rivalry are now being forced to pick sides, potentially reshaping global economic alliances for years to come. In the end, while Washington's tariff strategy may have been designed to strengthen America's economic position, the broader consequences suggest that the global economy is entering a new era of uncertainty, one where trade policies are increasingly shaped by geopolitical rivalries rather than economic pragmatism. The United States' decision to impose a 145% tariff on Chinese imports was framed as a move to protect domestic industries, but its ripple effects are already being felt across the economy. While the policy was designed to reduce dependence on Chinese goods and bring manufacturing jobs back to America, it has also led to significant cost increases for businesses and consumers. As a result, industries that rely on imported raw materials, components, and finished products are facing mounting financial pressure, which is beginning to impact employment rates and consumer spending. One of the most immediate consequences of the tariff hike is the rising cost of production in key sectors. U.S. businesses that rely on Chinese materials, such as steel, aluminum, and electronic components, are now forced to pay significantly higher prices, driving up overall manufacturing costs. This is particularly evident in the automotive industry, where major manufacturers have already signaled that vehicle prices will rise in response to increased costs. The higher prices are not only affecting large automakers, but also small and medium-sized enterprises, SMEs, that produce car parts and accessories. Beyond manufacturing, the agricultural sector has also been hit hard. In retaliation for U.S. tariffs, China imposed a 34% duty on American agricultural products, including soybeans, corn, and pork. Given that China has historically been one of the largest buyers of U.S. agricultural exports, this move has severely impacted American farmers, especially those in the Midwest. Many of these farmers already operate on thin profit margins, and with declining export opportunities, some are struggling to stay in business. Reports suggest that farm bankruptcies have increased in recent months, raising concerns about the long-term viability of the sector. Another critical issue is the impact on consumer prices. With businesses facing higher import costs, these expenses are being passed on to American consumers. Essential goods, including electronics, household appliances, and clothing, have all seen noticeable price increases. Middle and lower-income households, which allocate a larger portion of their budgets to basic necessities, are being disproportionately affected. As a result, consumer confidence is beginning to decline, and retail sales have shown signs of slowing. The job market is also experiencing shifts as a result of the tariffs. While some industries have seen an uptick in domestic hiring, many others are facing layoffs due to supply chain disruptions and declining demand. Companies that previously relied on stable and affordable imports from China are now struggling to adjust their business models. This has led to job losses in sectors such as logistics, retail, and manufacturing, with some factories forced to cut back on production or shut down entirely. As these economic pressures mount, analysts warn that the U.S. economy could experience slower growth in the coming quarters. The stock market has already reacted to the uncertainty, with increased volatility and investor concerns about long-term stability. If the trade war continues to escalate, there is a growing risk that businesses will delay investment decisions, further dampening economic expansion. Despite these challenges, the U.S. administration remains committed to its trade policy, arguing that the short-term pain will lead to long-term gains by fostering domestic production and reducing reliance on foreign supply chains. However, the effectiveness of this strategy remains in question. Some experts argue that the economic disruptions caused by the tariffs outweigh the potential benefits, especially if trade partners continue to retaliate. Ultimately, the full impact of these tariffs will depend on how long they remain in place and whether negotiations with China lead to a resolution. If the trade conflict continues, businesses and consumers alike will need to brace for further economic uncertainty, rising costs, and potential shifts in global trade dynamics that could reshape the U.S. economy for years to come. In response to the United States' unprecedented 145% tariff hike, China has been forced to recalibrate its economic strategy. While these tariffs pose significant challenges for Chinese manufacturers and exporters, Beijing is actively implementing countermeasures to mitigate their impact. Rather than relying solely on retaliatory tariffs, China is pursuing a multi-pronged approach that includes diversifying trade partnerships, stimulating domestic demand, and bolstering technological self-sufficiency. One of China's primary strategies is expanding its trade relationships with other global partners. The Chinese government has accelerated negotiations with countries in Southeast Asia, Latin America, and Africa to strengthen economic ties and offset losses from the U.S. market. Through trade agreements and infrastructure investments, many of which are part of the Belt and Road Initiative, BRI, China aims to create new export markets and reduce its dependence on American consumers. Countries like Brazil, India, and Indonesia are emerging as key trading partners, offering alternative destinations for Chinese goods and raw materials. At the same time, China is making a concerted effort to boost domestic consumption. The government has introduced new economic policies designed to encourage household spending and support small and medium-sized enterprises, SMEs. Measures such as tax cuts, subsidies for local manufacturers, and investment in emerging industries are part of a broader effort to shift the country's economic model from export-driven growth to one that relies more heavily on domestic demand. While this transition will take time, increasing consumer spending within China could help counteract the decline in exports to the U.S. Another crucial aspect of China's response is its focus on technological self-reliance. The trade war has reinforced Beijing's determination to reduce its dependence on foreign technology, particularly in sectors like semiconductors, artificial intelligence, and renewable energy. China has significantly increased funding for research and development, aiming to build a more independent tech ecosystem that can withstand external pressures. Major Chinese companies, including Huawei and SMIC, Semiconductor Manufacturing International Corporation, are already investing heavily in domestic innovation to reduce reliance on U.S. components and software. A key example of China's economic countermeasures is its decision to restrict exports of rare earth minerals to the U.S., given that China controls nearly 70% of the world's rare earth supply. This move directly impacts American industries reliant on these critical materials for the production of electronics, batteries, and military equipment. By leveraging its dominance in this sector, China is signaling that it has its own economic tools to exert pressure on Washington. Additionally, China is increasing financial support for its struggling businesses. The government has expanded access to low-interest loans and offered targeted assistance to industries hit hardest by U.S. tariffs, such as textiles, electronics, and machinery. The People's Bank of China has also adjusted monetary policy to ensure that businesses can access the liquidity needed to navigate this economic turbulence. Despite these proactive measures, China still faces significant economic headwinds. The loss of the U.S. market, which has historically been one of China's largest trading partners, cannot be easily replaced. Additionally, rising production costs and an increasingly complex global trade landscape mean that Chinese exporters must find new ways to remain competitive. Looking ahead, China's economic response to U.S. tariffs will likely shape its long-term trade policies and global economic positioning. If Beijing successfully diversifies its trade partnerships and strengthens its domestic economy, it could emerge from this trade war with a more resilient and self-sufficient economic model. However, if trade tensions continue to escalate without resolution, the global economy may face prolonged instability, with both China and the U.S. experiencing lasting economic repercussions. The escalating trade war between the United States and China is not just a bilateral dispute. It has far-reaching consequences for the global economy. With two of the world's largest economies locked in an economic standoff, international markets, multinational corporations, and smaller economies are all feeling the pressure. The ripple effects of tariffs, retaliatory measures, and supply chain disruptions are reshaping global trade patterns, causing uncertainty in financial markets, and altering economic forecasts for multiple countries. One of the most immediate global consequences has been the volatility in financial markets. Investors worldwide are closely monitoring the trade war, and stock markets have responded with significant fluctuations. Key indices in the U.S., Europe, and Asia have experienced sharp declines whenever new tariffs or retaliatory measures are announced. The uncertainty surrounding global trade has led to risk aversion, with investors moving their assets into safe haven investments such as gold, bonds, and stable currencies like the Swiss franc. Beyond financial markets, supply chains are also undergoing significant disruptions. Many multinational corporations rely on complex global supply networks that span multiple countries, with China playing a central role as both a manufacturing hub and a major consumer market. The imposition of U.S. tariffs has forced companies to rethink their production strategies, with some firms relocating manufacturing operations to other countries such as Vietnam, Mexico, and India. While these shifts provide new opportunities for emerging economies, they also come with increased costs, logistical challenges, and potential geopolitical risks. For smaller economies, the trade war presents both challenges and opportunities. On one hand, countries that have strong trade ties with either the U.S. or China are experiencing economic turbulence as demand for their exports fluctuates. Nations heavily dependent on Chinese demand for raw materials, such as Australia, Brazil, and several African countries, are facing declines in commodity prices and reduced export revenues. On the other hand, some countries are benefiting from the shift in trade flows. Nations in Southeast Asia, including Vietnam and Malaysia, have seen increased foreign investment as companies seek alternatives to China for manufacturing. Currency markets have also been affected by the ongoing trade war. The Chinese yuan has depreciated against the U.S. dollar, partly as a response to tariffs and partly as a strategic move by Beijing to keep its exports competitive. This depreciation has triggered concerns about potential currency wars, where multiple countries manipulate exchange rates to gain trade advantages. If such a scenario unfolds, it could further destabilize global trade and financial stability. Another key area of impact is global inflation. As tariffs drive up the cost of goods, inflationary pressures are mounting in several economies. In the U.S., higher import costs are pushing up consumer prices, leading to concerns about reduced purchasing power. In China, manufacturing costs are also rising due to supply chain disruptions, affecting the competitiveness of Chinese exports. If these trends continue, central banks around the world may be forced to adjust their monetary policies to control inflation, potentially leading to higher interest rates and slower economic growth. The broader economic uncertainty caused by the trade war is also influencing corporate decision-making. Many businesses are delaying expansion plans, postponing capital investments, and reducing hiring due to the unpredictable trade environment. The longer the dispute persists, the greater the risk that global economic growth will slow, with some analysts warning of a potential recession if trade tensions continue to escalate. Ultimately, the global economic impact of the U.S. China trade war extends well beyond the two countries involved. As supply chains shift, financial markets react, and inflation rises, the consequences are being felt worldwide. Whether the situation stabilizes or worsens will depend on the willingness of both Washington and Beijing to negotiate a resolution. Until then, businesses, investors, and governments must navigate an increasingly uncertain global economic landscape, where trade policies are driven as much by political considerations as by economic logic. As the U.S.-China trade war continues to evolve, economists and policymakers are grappling with its long-term consequences. Beyond the immediate economic disruptions, this ongoing conflict is reshaping the global economic landscape, influencing trade policies, and accelerating shifts in geopolitical power dynamics. The decisions made by both countries in the coming months and years will determine whether this dispute leads to a lasting transformation in global trade, or if a resolution can be reached to stabilize economic relations. One of the most significant long-term effects of the trade war is the potential decoupling of the U.S. and Chinese economies. Over the past several decades, globalization has created an interdependent relationship between these two economic giants. However, with rising tariffs, trade restrictions, and growing distrust, both nations are moving toward economic separation. The U.S. is actively encouraging companies to shift their supply chains away from China, while China is focusing on self-sufficiency in key industries such as technology and manufacturing. If this trend continues, the world may see the emergence of two separate economic blocs, each with its own trade networks, financial systems, and technological ecosystems. The trade war is also accelerating innovation and domestic investment in both countries. In China, the push for technological independence has led to increased government funding for artificial intelligence, semiconductor manufacturing, and renewable energy. Companies that once relied on U.S. technology are now being encouraged to develop homegrown alternatives, reducing China's vulnerability to future trade restrictions. Similarly, in the U.S., there is growing support for reshoring manufacturing and investing in domestic industries to reduce reliance on Chinese imports. While this shift may create new economic opportunities, it also comes with challenges, such as higher production costs and the need for workforce retraining. Another key factor shaping the future outlook is the potential for new trade alliances. As the U.S. and China drift apart economically, other nations are stepping in to fill the void. China has been strengthening its trade relationships with countries in Asia, Africa, and Latin America, while the U.S. is deepening ties with allies in Europe and the Indo-Pacific. Regional trade agreements, such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, and the Regional Comprehensive Economic Partnership, RCEP, are gaining importance as countries seek stability amid global uncertainty. Despite these long-term shifts, there is still the possibility of de-escalation and negotiation. Trade wars are costly for both sides, and as economic pressures mount, leaders in both Washington and Beijing may seek a compromise. Diplomatic talks, mutual tariff reductions, or sector-specific agreements could provide a pathway to easing tensions. However, given the broader political and strategic rivalry between the two nations, any resolution is likely to be temporary rather than a complete restoration of past trade relations. Looking ahead, the long-term impact of the trade war will depend on several factors, including government policies, business strategies, and global economic conditions. If the conflict continues unabated, it could lead to a prolonged period of economic uncertainty, slower global growth, and deeper geopolitical divisions. However, if a resolution is found, it could pave the way for a more balanced and sustainable trade relationship between the world's two largest economies. Ultimately, the future of global trade is at a crossroads. Whether the U.S. and China continue down a path of economic decoupling or find a way to coexist in a new trade framework will shape not only their own economies, but also the broader international order. For businesses, investors, and policymakers, navigating this uncertain landscape will require adaptability, strategic planning, and a keen awareness of shifting global dynamics. As the trade conflict between the United States and China continues to shape global economic trends, policymakers, businesses, and international organizations must consider strategies to mitigate the negative effects and foster a more stable trade environment. While the long-term resolution of this trade war remains uncertain, proactive policy measures can help minimize economic disruptions, promote global stability, and ensure sustainable growth. One of the most critical policy recommendations is for both the U.S. and China to prioritize diplomatic engagement and structured negotiations. Rather than relying solely on tariffs and economic sanctions, both sides should seek to establish clear communication channels and negotiation frameworks that promote mutual understanding. International institutions such as the World Trade Organization, WTO, and regional trade alliances could play a role in facilitating discussions, ensuring that trade disputes are resolved through dialogue rather than escalating economic retaliation. A phased approach to de-escalation, including sector-specific agreements and tariff rollbacks, could serve as a foundation for rebuilding trust and cooperation. Another key policy recommendation is the diversification of global supply chains. The trade war has exposed vulnerabilities in over-reliance on a single country for manufacturing and raw materials. To enhance economic resilience, businesses and governments should encourage investment in alternative manufacturing hubs, such as Vietnam, India, and Mexico. By developing regional trade networks and reducing dependence on U.S. China trade flows, economies can better withstand future disruptions and create more balanced global trade dynamics. For the United States, investing in domestic industries and workforce development is essential. Policies that support reshoring manufacturing, incentivize technological innovation, and improve job training programs can help mitigate the impact of trade restrictions. Expanding public-private partnerships to develop high-tech industries, such as semiconductors and renewable energy, will reduce reliance on foreign supply chains while fostering economic growth. Additionally, tax incentives and subsidies for companies relocating production back to the U.S. could help maintain a competitive edge in the global economy. Similarly, China must continue its shift toward domestic consumption and technological self-reliance. Government initiatives that encourage household spending, strengthen small and medium-sized enterprises, SMEs, and support innovation in key industries will be crucial in sustaining economic growth. Reducing dependency on foreign technology through increased research and development R&D, funding and boosting investment in artificial intelligence, biotechnology, and green energy will further enhance China's economic resilience. Additionally, China should strengthen trade partnerships with emerging markets in Asia, Africa, and Latin America to diversify its export markets. Global institutions also have a role to play in stabilizing the trade environment. The WTO, International Monetary Fund, IMF, and regional economic organizations should work toward modernizing trade rules, ensuring fair competition, and addressing concerns related to intellectual property rights and market access. Reforms that promote transparency, prevent unfair trade practices, and facilitate dispute resolution will be crucial in reducing tensions between major economies. For smaller economies caught in the crossfire of the U.S. China trade war, strategic adaptation is necessary. Countries that have traditionally depended on trade with China or the U.S. should explore new markets, invest in infrastructure to attract foreign investment, and leverage regional trade agreements to maintain economic stability. Strengthening local industries, improving digital infrastructure, and enhancing trade facilitation measures can help these economies remain competitive in a shifting global trade landscape. Ultimately, navigating the U.S.-China trade war requires a combination of strategic policymaking, international cooperation, and business adaptability. While the conflict presents significant challenges, it also offers an opportunity to rethink global trade structures, encourage economic diversification, and build a more resilient global economy. By focusing on diplomatic engagement, supply chain flexibility, and technological innovation, policymakers and business leaders can help shape a future trade environment that is more stable, sustainable, and mutually beneficial for all stakeholders.